Okay, we're gonna get started. I'll just remind you about your cell phones, if you can put them on vibrate. My name is Mark Gilbert. I'm with Elko and Associates, and we're sponsoring the Business Tracks. I'm also get the privilege to be on this panel with Robert Moe, who founded Ram Capital and is currently the CFO at AM Security, and Jim Karen, who is the Senior VP of Doyle Security. We're going to go over the various financial metrics in the industry, things that you really need to know about your core business. And with that, so I keep it short, I'm going to let Robert Moe get started first.
Really short.
It's really short, yes.
Oh, there we go. So this is the first slide that I thought Mark was going to talk about, so I'm not really ready to say. Anyway, the topics that I'm going to cover are creation cost and the ubiquitous term EBITDA, which basically it means the cash flow to run your business. We think that you folks are the smartest alarm dealers at the show this year because we think this is the most important session that you could attend. These are the fundamentals by which you'll either succeed or fail, grow or shrink, and survive in coming years. So credit goes to you for showing up. See if I can do this again. Okay, creation costs. I'm going to start with that, and then I'll talk about EBITDA. But I'm pretty sure you all know what they are. They're the costs that you incur in order to add new RMR to your business. It's labor, it's equipment and materials, it's sales cost. Depending on the level of accounting that you use, you may have G&A expenses that are really directly related to creating new accounts for your business, new RMR. And we all know that the RMR is the core of value in your business. You are really in two parts of the security industry. One side is sales and installation, and the other side is a recurring revenue business where you're providing service and basically getting an annuity. And it's that annuity side that the marketplace values, that the banks lend against, that buyers buy. That's what you're trying to build your business to achieve. So it's very important to understand what your costs are to create that value. Obviously, if it costs more than the account is worth in the fair market, then you're spending too much on creation costs, and there are plenty of examples of companies that have done that and gone astray. So creation costs are all of the pluses that I have there, minus installation revenues, and this is either a positive or a negative number. I think if you're a residential company, you may find that this is very often a negative number because you don't often recoup all of the costs that you have sunk into a residential installation, especially if you're competing in the mass market. If you're a commercial company and you're doing a lot of additional work, or maybe fire systems or access control along with the security, you actually could have a positive number as a result and not have a creation cost, but have a creation profit. But most companies end up investing something in building the recurring revenue. One thing that's important to remember is that your creation costs have to be funded. They have to come either from your internal cash flow, or if you're growing fast enough, you're going to start looking for lenders to support that growth. Lenders that will come in and lend against multiples of cash flow. So let's go through a quick example here. You can see in the top we've got the direct creation costs, the installation expense, which is basically your labor, and I would encourage you to use loaded labor, meaning include your workers' comp in there, include overtime, things that your accountant may want to stick down in G&A, include up in there, insurance costs. I'm going to skip capitalized creation costs for a second. Sales and marketing costs, they speak for themselves. The cost that you incur to get your name out in the public and get in front of a customer, pay a commission to a sales rep. Capitalized creation costs, some of you may incur. Very often, accountants, for tax reasons, or you may decide to capitalize some of the costs that go into installation, like the equipment and maybe some of the labor cost, which means that it doesn't become an expense on your P&L, it goes into your balance sheet as an asset. It's important to track those costs because it's really cash out of your pocket. Even though it's not showing up as an expense right now, it eventually shows up as an expense as you depreciate it over time. But more importantly, it's a check you have to write, because when you're buying Honeywell equipment, they don't care if you capitalize or not, you got to pay the bill when it comes due. So you add that into your creation cost to get a total direct creation cost number. Subtract out installation revenues that you're able to collect, and you get the net creation cost before allocating any G&A cost. Now, most companies, if you're on a growth path, you probably have people and systems included in general and administrative expense that you wouldn't have if you stopped growing. If you decided to shrink and just stand still, you probably wouldn't keep all the people that you have in G&A, so that there's some amount of G&A costs that would go away that could be attributed to installation expense. Also, many companies will include in G&A insurance costs for their labor force, such as workers' comp and things like that. They don't break it out. They're clearly related to the creation costs, so I typically encourage people to separate these and count them as part of creation costs. At the end, you get a net creation cost number, in this example, of $400,000. Now, for argument's sake, let's say that you've created $13,500 of recurring monthly revenue by investing that $400,000 on a pre-G&A basis, which is the bottom number. You can see that that equates to a 22 multiple. If you include the G&A costs that we put in here arbitrarily, you can see that that cost is closer to 29 times. And I think you'll find in the industry that it's very typical to find creation costs in that 26 to 30 times range, especially, once again, especially on the residential side of the business. So the important numbers to remember from this slide right now are the creation cost multiples, because I'm going to use them again later. So the 29.6 times is what you're investing in a new account, which you are hoping is either going to be around for 60 months or more so that you can make a profit on it, or that some buyer is going to come along and offer you 38 to 42 times for it, and therein you've created value with that account. Let's move on to EBITDA. EBITDA is an acronym for earnings before interest, taxes, depreciation, and amortization. And it's basically the cash that you have available to run your business. Another term that I'm going to come back to in a minute is adjusted EBITDA. And this is a term used by bankers and also by buyers to estimate what the cash flow of a company would be if you added back the creation costs. In other words, if the company was just running to produce RMR and the profit from RMR. One of the things that most lenders will do, and certainly when I'm working with a company in terms of putting together a financing, is we calculate the steady state EBITDA. And steady state simply means that you are not growing, but you are also not shrinking. So you're using enough of your cash flow, enough of your EBITDA, to replace any attrition that you incur. So you're basically zero growth, zero shrinkage, and the cash flow that results from that is your steady state EBITDA or steady state cash flow. This is extensively used by buyers and lenders in terms of determining valuation, and for lenders in determining what they're willing to lend to a company. So I come back to my comment earlier, it's very important, no matter what level of accounting that you do, that you are able to understand what your EBITDA is and what your adjusted EBITDA is, and I'll show you a little bit more about that now. So here's a rough example of how you would calculate operating income or EBITDA. You have net income, which comes off a traditional income statement, and you would add back any non-cash charges such as depreciation and amortization, add back interest expense, and add back income taxes, and that's the amount of cash that you have available to run your business. Now, you still have to meet all of those obligations. So in calculating this number, you have to remember that that's the cash that you're going to have to service debt, to make capital expenditures, pay your taxes, replace attrition, and grow. Oh, there's the definition. Just so that I can give you an example of the other things that can affect your cash flow, we created an example here showing an EBITDA of $500,000. This would be a company that has borrowed and they have debt service to pay, so out of that $500,000, $200,000 would have to go pay the debt service, which is principal and interest. They have maybe income taxes of $50,000, non-finance purchases, which would mean CapEx that hasn't been financed under a finance lease. So these are other costs that don't typically flow through the profit and loss statement, the income statement, but they are cash expenses that you have to take into account. And other balance sheet changes. Very few companies realize that all of the cash effects of running your business don't run through your income statement. You can have changes from year to year in your accounts receivable, your accounts payable, your inventory. Those things all either use or contribute cash. So you can have changes in your cash position that are affected by how much inventory you have, what your accounts payable are, what your accounts receivable are. And those are things that need to be tracked as well so that you can understand how much cash is available. So a company with $500,000 in cash flow doesn't necessarily have $500,000 to spend. They have other obligations, and in this particular case, the net cash flow is $300,000. So don't forget the non-income statement related transactions that affect you. Now, I thought I'd go back to show you an example of adjusted EBITDA. And remember that $500,000 number, it's not on the slide, but that $500,000 EBITDA is what we're starting with. And to continue the example, we're using new RMR of $13,500. During the course of the year, this particular company had $6,500 worth of attrition. So the net new RMR is $7,000. Now, we calculated before that the creation cost multiple was 29.6 times. So what we're saying here is that in order to replace that attrition, the company had to spend at least 29.6 times the $6,500 in order to stay even. The $7,000 of net new RMR cost them the additional amount, 29 times that amount, to get the creation cost. So the growth of $7,000 is an amount, the creation cost of that $7,000 is the amount that would be added back to EBITDA to show the adjusted EBITDA. Now, who would look at this? This is typically what a bank looks at when they're looking for sources of repayment. And they will say, we know what your EBITDA is with growth. Well, without any growth, what would your EBITDA be? Because if you had to stop growing and repay my loan, I need to know how much cash flow you can throw off. And basically what we're saying here is that with growth, if with the $7,000 in RMR growth, cost $207,000 to do. If you didn't have that growth, if you just replaced attrition, you would have $707,000 of net cash flow. So the idea here is to look at the company as if it's running in a steady state, staying at zero. And this is a calculation that is an example of adding back the cost of the growth. Well, this sword cuts both ways. Suppose now, instead, we have a company that has $3,500 of new RMR, but they still have $6,500 of attrition. The net new RMR is $3,000, which means that they're not staying even. So what would it cost, or what is the estimate of the cost to replace the attrition to stay even? Using that same 29.6 times the $3,000 of loss, which would bring the company back to zero growth, it would cost an additional $88,000. So a lender looking at this company would say, well, you know, if I'm lending against a certain amount of cash flow, but the company is losing recurring revenue, not growing, I know that this company is going to have to spend some of that cash flow just to stay even. And using the calculation of 29 times, we know the company is going to have to spend at least another $88,000 to replace the attrition that it had. So the real adjusted cash flow for this particular company is $411,000, not $500,000. Once again, the concept here is that you want the company to be reflecting cash flow that it would have at a steady state, at a state where it's not growing or shrinking. So why is this important? Well, a banker looks at a company and they look for two sources of repayment. One source of repayment is the ordinary cash flow of the business when everything's going fine. But the second source of repayment is the company is running into problems. They have to cut back on their creation costs in order to service debt. And so the bank will calculate this adjusted EBITDA in order to determine what level of debt the company could support. So moving into financial covenants, typically what a bank will look for these days is a senior debt level of 3.5 to 4 times this adjusted EBITDA number. Once again, this is why it's important to be able to back into that number, that steady state EBITDA number. And total debt, if you're a company that has senior debt plus additional equity investment or subordinated debt in a company, typical covenants for those levels would be 5 to 6 times this adjusted EBITDA number. My experience has been that while there have been times where companies are able to borrow at higher multiples than this, it's rare that they can sustain the ability to repay it, and they usually run into trouble. So as you're thinking about your company and you're calculating first EBITDA and then your steady state or your adjusted EBITDA, and you're thinking about borrowing, this is the 3.5 to 4 times level is probably what you should be thinking of as your max. Now, the other test that a bank will use to determine how much they will lend is the ability to service the debt. So in a typical transaction where it's a revolving credit, where you're paying interest only for the first few years, the interest coverage, meaning the adjusted EBITDA to cover the amount of interest due, typically the covenants run from 1.25 to 1.5 times. And once again, as someone who advises companies, I would say that for the company's safety, you don't want the number to be any lower than that. You don't want coverage any tighter than levels like this. It doesn't give you any wiggle room if there's a problem. Total debt service coverage, meaning you're paying principal and interest, can be a little bit lower. But once again, you have to have a higher amount of adjusted EBITDA than the amount of debt service that you are faced with, because you may also have taxes to pay. You're going to want to grow. You want to continue to grow. So you need to have a higher number than some of these minimums. In terms of potentially an exit strategy in the future, or a bank looking at a company valuation with regards to what the collateral is worth, they look at it the same way. They will look at adjusted EBITDA and apply typical multiples of adjusted EBITDA as a method of valuation. This industry is defaulted to multiples of recurring monthly revenue. You read about them all the time in the various trade publications. And it's primarily because it's so difficult to evaluate what the EBITDA is for private companies. They don't publish the numbers, they don't talk about it. So the only common denominator most of us have that we're when we're reading about transactions is this multiple of RMR. But I can assure you that buyers and lenders are not looking at that number as much as they are looking at what the adjusted EBITDA is for a company and what their ability to service the debt is and what the value of that business is based on that cash flow. And I think that's my last one. Thank you. Do we want to take questions right away? Sure.
Yeah.
Take a couple. Yeah.
Just a couple questions. Is it reasonable to expect ever net positive acquisition costs, rather negative acquisition costs, or should you always expect that it costs you money, net money to acquire?
No, it is possible to think about it. I would think high-end residential, where you're putting a lot of equipment in that you can charge for, special equipment, cameras, access control maybe, and certainly in commercial and in fire, there is an opportunity to charge what the equipment and the labor is worth. When you get down and dirty with Comcast and ADT, and you're up against the $99 system, no, you're probably not going to, if you're taking $99, you're not going to make money on that.
Sure.
And that's where most of the negative creation costs are developed. It's in that end of the business.
If you're thinking of an overall business plan or budgeting for the next year, is it reasonable to have a business plan, even in a residential market, that assumes even neutral, or is that really unrealistic? As you said, if you're going against, clearly if you're selling a system for $99, you've got
Yeah.
positive customer acquisition costs.
Yeah.
I guess is there a viable business model where you say, no, I'm going to at least put it on my portfolio?
Yes, I think it's a decision you make, and if you're monitoring your activities every month, you can control that. But this is a matter of controlling your sales guys and your installers. And when they're going out there, you have prices that are set, and if you're bidding against the $99 system, your story is my RMR is lower. It's not $60 a month. It's $30 a month, and you're paying for it up front.
But you may be giving RMR multiple value of your business if you're not willing to cut prices.
Yes, you would think so, but remember, you're investing $1,000 or $1,500 in that system that you have to recover from that higher RMR multiple before you get that value. So it is truly a trade-off. But I think the answer to your question is that you decide. You decide what your business model is going to be, and that means you might not get that low-end business. Then maybe that's not a bad thing.
If you can have one more question.
Sure.
I know this was more fine point, but on the capitalizing those costs, you said some accountants would want to capitalize. Is that just their conservatism, or is there a tax benefit? I would think it would be a negative tax.
It often is just being conservative in the fact that the tax accountants often don't understand our industry.
Okay.
Most companies I know want to expense as much as possible, right? But not everybody does. And there are situations where if you're in the commercial business, and Mark, you could probably speak to this better than I can, but if you're in the commercial business and you're leasing a big system and you're going to own that system, you may actually have to capitalize it. But you don't want to lose sight of the fact that you had to push that money out the door to do the job, as part of your investment.
The other reason sometimes you'll see companies capitalize that is depending on their financing, whether it's private equity or straight loans, they need to show, you try to show EBITDA at certain levels before it's adjusted. Or if you're publicly traded, your earnings per share would,
So the optics of hitting certain metrics.
yeah. On your point with modeling, doing a projection for a new company or with suggesting that you would break even, I would suggest that, I personally would suggest not doing it that way because it's going to be really hard to hit that number.
Do you have top of your head kind of what, I guess it's different market to market.
Well, and you can correct me if I'm wrong, but I believe last year in 2012, the average in the industry, and they don't separate residential and commercial when they give you this number, is somewhere around 28 to 30 times.
20 to 30
The times the recurring,
Cost, the calculation at the time.
yeah,
Yeah, at least, yeah, that would be the good range.
Okay, I only have one slide here, I think, so maybe that'll be good for you. I think maybe just hit enter, yeah. Attrition. Robert just finished up talking about how much you can spend to acquire new accounts. So the obvious thing, once you have accounts, is do everything you can not to lose them. Now, a simple calculation, simple measure for attrition is just take the sum of all cancellations, reductions in RMR, and divide it by your average RMR. We publish ours monthly, but at informal meetings quarterly, we just take our losses for the quarter, annualize that, and divide it by our beginning RMR and whatever our RMR is at that point in time. Some people will take, as the months go along, will average all the months out versus, and divide it by the losses, or divide that into the losses. It probably gets you to the same number, pretty close to the same number. Okay, what can you do to improve customer retention and reduce attrition? We have listed here, the first item is company culture, and I really do believe that's the single most important thing. We, at Doyle Security Systems, it's really a religion. You hang on to every customer, and interestingly enough, we'll talk about the next step, I'm going to blend some of these together, understanding the cost of a new customer versus the cost of satisfying a customer. When we're dealing with a current customer that either wants a new system put in, wants a reduction in their RMR or whatever, we're constantly, the people there are constantly calculating the creation multiple. And if it's creation multiple to keep a customer, the logic is simple. Sometimes it's hard to calculate it, but if the cost of keeping a customer is a multiple of 5, and you know your typical creation multiple is 25 or 30, it's an easy decision to make. Invest in the current customer, hang on to them, and obviously sign them up for a new 5-year contract or whatever. But going back to the culture, I always thought we were, I've been with Doyle practically my entire life. It's been 39 years, so I have a huge history there. And I always thought we were a very good company, and about 6 years ago, we got into trying to develop the culture more in terms of providing great service, raising the bar, not letting customers go, and just trying to drive down attrition. And we developed a program called Promise and Deliver. And before I get into it a little bit more, our first year, I'll read some of our attrition numbers. Our first year in 2008, our gross attrition for alarm systems was calculated similar to that, was 9.4%. And from that point to 2012, we went 9.4 down to 8.3, down to 7.7, down to 6.5, and last year we popped up a little bit to 6.8. But anybody that's got a calculator can quickly, if you know what your creation multiple is, and if you're starting with 700,000 in RMR and you've improved your attrition rate by 1 or 2 percentage points, it gets into large numbers very quickly. So, company culture. We just got employees to come up with a name for it, Promise and Deliver. We hired consultants to come in and train us and teach us. And the way we got the consultant is the primary owner of the company went away to a resort in Canada one weekend, and he was overwhelmed by the customer service there, so he sought out the general manager of the resort, had a conversation with him, who told us who the consultant was that trained his company, and we had the general manager and the consultant train us. And it is, I'll just give you parts. Everybody's empowered to save a customer. If you don't want to work and save customers, you really probably don't have a position in the company, and it goes from there. I could go on and on about it, but it does work. It's a matter of educating, and I hate to even say this, but it's a little bit about like religion. You either believe or you don't believe. And with us, you got to believe. The last thing I would say on that, another thing we pulled out of the company culture was a great survey program. And we used the survey system, I'll call it the Net Promoter Score, which was originally, I think, developed by a professor at Harvard. And interestingly enough, the key, we asked like 2 questions in our survey. And one of the questions, and I'm very excited for ESX, it's on your rating sheet there. Would you recommend us to a friend or a colleague or a fellow business person? And if the customer, we give them a little scale, just like they have here, 1 to 10. Someone says 10, 9, that means they're a promoter. And what's very important about them, those people will go out in the community and tell other people how great their security system is, et cetera, or their home automation system, or whatever it is, to as many people as they can talk to. 8s and 7s we deem as neutral, and anyone below a 7, the theory is they're a detractor and they will talk you down and hurt you in the marketplace. So we push everybody to get surveys. It's just tremendous how we bring in thousands of surveys a year. Anyone with that comes in with is ruled a detractor. The goal is the branch that had that issue needs to get to that customer. I think it's like within 2 business days, have a conversation with the customer, try to rectify everything, and then we end the survey deal with is once a quarter, we visit each branch, the executives, and one of the things we do is we go down through every survey that was rated as a detractor, try to learn something from it. What did you do? How did we improve this, et cetera, et cetera. Very methodical, but by gosh, it did work. And we have a great culture, and 2013 is deemed the year where we try to raise the bar higher and do things better, whatever. It's a lot easier to do that than to pay 30 to 35 times RMR to create a new customer. It's as simple as that. Okay, analyze your attrition rate by various segments. We have 9 segments, and it's published monthly, each category. And of the 9, some of them are obvious, people that sell their homes and move. That's obviously one of the biggest reasons residentially you lose a customer. We take a couple other categories and we call them controllable losses. They're a controllable loss. And what we mean by a controllable loss, that was preventable. And it kind of ties back into the culture again in the P&D program. Any person saying they're leaving us because they're unhappy for whatever reason, anyone that says they cannot afford the alarm system or system, that's another controllable loss. And the third one is, I don't use the system any longer. We feel that the team, the company, can control those things, and we zero in on that. And again, in meetings, we review every single cancellation that falls in that category. When you what makes me what comes to mind is an old phrase, when we say analyze them by segment, understand the cost of a new customer, et cetera, et cetera. An old phrase that I always preach at the office is, if you don't measure it, you can't manage it. You don't want to do this by the seat of the pants. You want to be able to say that my attrition is 8.65% for this year or whatever. Here's the categories and here's what we're doing about it to drive it down. The next one's a very important one, recapture site addresses. We call those COEs, change of equities. Gives you two chances. Good customer, if they move within your current marketplace, try to sell them another system. Or if they're moving in where there's another system, try to convert that system to your company. And then you definitely want to, the new homeowner moving into that, the former site, you want to try to sign that. And it really always ties back to Robert's discussion on creation costs, because you want to really work that hard, and our goal is 60%. If we lose 200 or 600 customers that way, we want to get at least 60% of those sites back each year. And one of the reasons is you want the RMR, but also it's a very low creation cost. I mean, it might be 2, 3, 4, which is really, the only thing better than that is have a price increase, which is 0. So change of equities, work on that. Accountability, everybody, we have about 100 employees, and from the frontline people to the people doing billing, payroll, vendor payments, or whatever, all need to be able to face the customer, handle them properly, and provide them great service. We know there are a lot of, you can run into some angry or miserable people at times, but you need to train and understand how to handle each and every customer. There is an answer to every problem, a positive one. So I'm just trying to think, the final little comment I'll make is another little catchphrase for this is what I say is RDA. Remember that? It's retain your customer first, develop them, get more RMR from them, sell them additional services. And the final thing you should do is go out and acquire other customers, whether it's organically or you're buying them in an acquisition or whatever. So always RDA. Keep your current customers. It's cheaper. You'll make more money that way. Industry benchmark, I've seen that before, 11 to 12%. I think that gets inflated by some of the larger companies. I read off some of our attrition rates. We do acquisitions, and it's not uncommon to find an individual that has 400 or 500 accounts, that if you really dig in and try to figure out his attrition will be in the low single rates, maybe 2, 3, 4% at best. That's because he or she knows all the customers generally and has a little bit of a relationship with them, and intuitively knows how to take care of them. They have their own promise and deliver program. The trick is when you buy those 500 to provide the same level of service. Gosh, I guess I'll just leave it at that. If there's questions, yep.
You mentioned your controllable losses were can't afford it, don't use it. What were the other ones?
Unhappy for whatever reason. We call it unhappy with system, service, or price.
You mentioned your survey had a couple of questions. One was, would you recommend us to someone else? What was your other question?
I think one of the other ones is, was our service person professional, on time, things like that. Just a couple questions like that. The key one is, would you be willing to recommend us? I actually read the book on it. If you go to the internet and Google it, just Google Net Promoter Score, and you could sit up all night reading about it. Nothing else? We'll move on then.
Okay, maybe one slide, but a lot of information. Extremely important. I'm going to talk about some of the other key ingredients that you need to look at beside creation cost and attrition. And normally when I go into a company, usually we do attack attrition first, and we'll look at your creation cost to help you get an understanding of what that is. One of the other things that seem to get lost at times is actually the cost, what it costs you for service, to service that customer. And 9 out of 10 times when I go into a company, they'll tell me that they're making money on service. And I can tell you that 9 out of 10 times they're not making money on service. You need to you have to make really a choice on whether you want to go with time and material or sell a lot of extended service contracts. If you don't have a large company and you're selling service contracts, you may not be covering your costs. You really need to analyze whether it makes sense if you don't have the volume. Even though that you're building your RMR, let's say you're adding $10, $15 a month, is that really going to cover all the trips out there? One of the other things is if you are selling extended service contracts, you need to keep track of what we call truck rolls. So when a customer calls that has a service contract, you want to try to solve that service problem without sending out a service person. Okay? You want to keep your costs as low as possible on those. If they do not have a service contract and you're charging time and material, I would tell you that in most cases you're best off rolling the truck if you can. So, unless it's something minor, obviously you don't want to lose your customer over something. So, the other thing you need to keep track of to keep your service costs down is how many service calls each technician is running a day. And that depends sometimes on your geography, how spread out you are. If you have the capability, if you're more condensed, the average that I see for a service tech in a day is usually around 5 or 6 calls in a day. And if they're not doing that and you have a small geographic area, maybe within 90 miles of your office, then I would suggest finding out what they're doing. One of the controls is and you can laugh, but it's true. One of the controls is either put GPS on their trucks. Okay, I've been behind the desk for 20 years in this industry, and I've had, service techs put in overtime, and their truck was parked in their house at at like 3 o'clock in the afternoon. So, the other thing is to control it. You might want to make sure they call you when they get to the house and when they leave that house. So it's important to stay on top of your service techs. You want to eliminate callbacks. You want to track which technicians that you're using. You have a lot of return calls for the same exact service. You either need better training or you may need a new tech. But it's important to stay on top of it. I find that most companies feel like they're making money on service and they kind of ignore this. And you want to break it out. You may have, if you're doing a lot of fire work, you might have a lot of fire certifications that you're making high profit on, and it's hiding the fact that the rest of your service is going in the tube. So I think it's just as important to dissect all the service information that you're getting. Basically, the billable services to RMR, the average in the industry is roughly running 10 to 11%. What that means is that your time and material, if you're recurring revenue, including your extended service agreements, let's say is $100,000 a month, you should be at about $10,000 to $11,000 a month in time and material. It's just kind of a trend in the industry. It's a way for you to benchmark yourself against somebody else. Yeah. So the benchmark in the industry, basically, or the trend has been that your time and material from service, your billable service, usually is running about 10 to 11% of your recurring revenue. It doesn't mean, well, if you're running 15%, you're doing better than the average. It doesn't mean, if you're running less, it just means you should probably take a look at what's going on. Are you going back? You have a lot of non-billable calls for some reason, a lot of callbacks, original warranty work, so you got to watch it.
Are you talking revenue or cost?
Talking revenue.
Revenue, okay, of your RMR.
Right. Some of the other things to look at is, talk about net organic growth. And what you need to do is make sure you have a sales plan and a marketing plan. And you want to track your leads that come in, where you're giving them, what salespeople are getting those leads, what's happening to those opportunities. Do you have certain salespeople that are closing better than others? Are you handing out leads to somebody that is not generating any self-leads? I mean, those kind of salespeople, I think that you need to really get on to generate their own leads. I think you reward the salespeople that bring in new business with fresh leads. You help them. You need to obviously set expectations with your sales force and make sure you measure them and stay on top of it. Corporate overhead and the infrastructure. Again, you want to try to control your costs, your overhead costs, because that's going to be a fixed cost for you for the most part. One thing that you should do is actually review every line item, make sure that there's no savings, because the small savings that you'll make per line item, whether it's insurance, if you're shopping insurance, or employee benefits, or for some reason your office supplies is high, or your travel expense, all that stuff adds up. Postage and printing cost. You can put in email billing, or use, ACH, or auto pay credit cards. All that also helps with attrition, by the way, the billing stuff, besides cutting your cost. So take a look at every line item. Telephone costs. I know one of the companies I worked at, we used to do a lot of acquisitions, and we took over a lot of phone lines in those acquisitions. And what happened is, 5 years later, we're looking at all these phone lines. We don't even know what they're used for. So we start calling them to see where they dial. So you need to stay on top of that. Look for efficiencies with the use of technology. I find that a lot of companies just hire people. They have a problem, they hire a person, they put the person on it. They don't look at any way to automate what's going on. And then evaluate your existing personnel constantly. Do not, just because someone's there for 15 years doesn't mean they should be there for 16 years, okay? You need to stay on top of your personnel. And you have to make sure that if you're growing, that they actually are what we call scalable, okay? That they actually can take on the more responsibility of a larger company, okay? Your infrastructure is very important if you're growing, okay? The overview, we covered creation costs. I don't think anybody could have done it better than Robert. I wish I could present half as well as he presents. So. Jim covered all the customer retention or attrition. You really have to know that number. And with creation costs and attrition, if you don't know what that number is, don't feel bad, because 50 to 60% of the companies I get sent to from banks for due diligence have no idea what it's costing or what attrition is. But you should get a handle on it. If you need help, there's plenty of people that can help you with that in the industry. But you need to get on top of that. We covered, the service margins, growing your business, and keeping control on that corporate overhead. It's really important to keep control of that. You don't want that to get out of hand. I don't have anything else. If there's any questions, I guess we can try to answer. Okay.
Let someone else ask it. I had a question on service revenue. It's kind of a similar question on that I asked before. So you made a comment about, you might be hiding the fact that you're losing money on service when you're doing a lot of fire inspection. Is it reasonable in doing your plan to factor in profit on service? Or for the attrition question, should you just assume, you have to provide that
and this is my opinion, okay, okay, that's what I'm gonna give you, okay. Might not be the rule, and maybe they won't, and maybe the other panel members won't agree, but if you look at the average margin for service and monitoring together, it runs somewhere between 57 and 60% when you allocate a portion of your overhead to that, right? So if you look at just monitoring, right, most of you are probably having 80 to 85% profit on just the monitoring itself, right? So it's unlikely that you're going to make a whole lot of profit on service. So I'm very conservative when I build models for companies that are going for loans or looking for investments, and I kind of try to match it to what the industry trends are so that we can actually answer the question, because if you're too much better than the trend and you don't have the history to back it up, the bank or a private equity person is not going to buy it, you know, unless you're telling them specifically what you're going to change. You know, so.
On the service agreements, you mentioned some benchmarks that I thought were helpful for an extended service agreement. What do you think a benchmark is? We might say 1% of a camera sale would be your recurring revenue that you charge for that. Some say point something.
I don't think I.
Or if you're gonna charge for a maintenance agreement, you mentioned here that you need to have enough volume to keep that going, to have that make sense. So we would say a $10,000 installation, what would be a good benchmark be?
Without recurring or with recurring?
Yeah, with recurring.
Okay. Well, it's been my, and anybody else want to answer that? I mean, my experience is this: if you, let's say you put in a camera system for 10,000 or whatever you're putting in, right? If there's no recurring attached, it's been my experience that you usually get about 15% of that installation price spread over the, you know, over the 12 months to come up with your recurring. Where we had, and this was actually with, I can tell you, Matrix Security, who I was with. If you had recurring and you did that kind of installation, we used 10% of that equipment cost, you know, of that installation cost. You have any comment on that, or?
On
'Cause I'm not-
commercial sales, and these are outright sales, someone wants a service agreement, generally will charge 0.75%, 0.75 to maybe 1% of the installation number, but it depends.
Is that a month?
Yeah.
A month.
Per month.
Per
Yeah.
month, that's per month, so you're getting to that 10 to 12%. Yeah. Anybody else? For anyone?
I have a question for the audience. How many of you produce monthly financial statements? How many of you look at them every month? Very good.
That's-
You're more than halfway there.
Go on. Let's give them, we want to come up here and just use the mic?
You mentioned an RMR multiple earlier in the presentation, 38 to 42 or something. Are there, for acquisitions, are there adjusted EBITDA multiples that are, as a buyer, I'm kind of looking at adjusted EBITDA, and are there sort of typical industry multiples that you see
Multiples of EBITDA?
of the adjusted EBITDA calculation? So we're talking like 4 to 5 times.
If I was looking at an acquisition, I would evaluate what my cash flow from that company would be, right? So it's going to be higher than the seller's probably. And I would probably, depending on the size of the deal, be looking in the 4 would be a great buy, 6 is probably the market, and people have paid higher. Bigger companies sometimes will stretch. This is anecdotal only, and it does change. When we go through peaks and valleys of the lending cycles in the banking community, it will have a direct effect on valuations in this industry. And if you look back at the history, you see multiples going up and down, and they tend to go up and down because whether or not there's, it depends on whether there's financing available to do them or not. And if there's not a lot of financing, there are not a lot of transactions at high multiples. Also, you gotta look at attrition and, you know, the other factors. It's your cash flow over time from that base. What's the RMR, what's the margin on that RMR? So there's a lot of factors that go in, so I'm hesitant to throw out a number and have you thinking, this is the range I can offer. It's more than that.
Yeah, I think the key to what Robert's saying too is how that acquisition is going to come into your company. What is going to be your cash flow from it? Okay, whether it's a fold-in, where you're buying a portfolio of customers and it's within the surrounding area where you're at, and basically you're just folding it in, maybe adding a few technicians and a person, versus a bigger acquisition, another office. And so you're going to get less savings from that. So I think, you know, the key to what Robert's saying is that there's so many factors when you're doing this, and a lot of companies will actually recast, well, they'll do a pro forma for financials in order to even borrow the money, okay, to do that acquisition. A lot of times you have to put out a projection.
That was the right question, though.
You know, that kind of typical way you've heard it in the past about, you know, a certain multiple of the RMR. Now with, you know, that always has in the past been based on probably traditional central station costs being involved as well. But now, you know, a lot of systems have, whether it's alarm.com or some other factor that actually increases, you know, the cost. How do you factor that in, you know, if you're looking at a deal? I mean,
Well, you do have to factor it in. I mean, you have to look at the cash flow that account is going to produce, and if it could be a $70 a month RMR for that account, but there could be $20 worth of cost in there. So, you know, you've got to start with the net profit or the gross profit from that account, net of the service costs. You know, is there alarm.com? Is there GSM cost? Is it more than just a standard monitoring account? It all comes back to the cash flow. You know, we talked about adjusted cash flow for the entire company. It really comes right down to the adjusted cash flow for the customer. And you often will hear of purchases at 62 times the RMR or 28 times the RMR, and you really can't tell whether that was a great deal or a horrible deal until you get behind the numbers. And it's for that what you're pointing out is part of the reason for that, because you don't know what the true value of that RMR base is until you get into the costs.
I don't know if this helps you, but, you know, in the last 3, 4, 5 years, I tell potential sellers, you know, here's a range of multiples, multiply it by your RMR, but I've begun to tell them, but exclude your alarm.com charges or AlarmNet charges or whoever's charges. It's like old telephone line charges. Those are just direct pass-throughs. You know, the counter argument to that is a lot of people say those types of customers that have interactive services will have greater staying power, you know, lower attrition, and they're worth more than that, but there's a give and take there.
Can I just want to make a comment on that, so I'll just stand up because she asked a question.
But one of the questions that always come up is, are all these interactive services going to lower attrition or not? And I go to a certain conference every year, and at that conference I've asked for the last 2 years, there's just not enough data that will support whether that customer is going to stay as sticky as we think, okay? You know, paying $70 a month versus what they used to pay $25, $30, they might decide that, you know, it was neat to have all this with your phone and you turn on your lights and you control your, but do they really want to pay $50 extra a month or $40 extra a month? So that's the problem you have with selling it, and you will end up with a pass-through, usually, a deduction for at least the cost of what it's costing you to have, you know, to have that monitored. So I just want to let you know that's part of the problem, yeah.
We have a local company that does not require contracts for monitoring. So how do you see multiples impacted by the term of the contract? And I know you mentioned a 5-year term. That doesn't exist in our market. So how do you see the RMR being affected?
Well, if you have no contract, I would say you're going to have a very hard time selling your business, because I've been doing this for 20-plus years. I think that, if you have a normal 3 to 5 year term, and I would suggest on contracts to put 5-year term, the worst can happen is somebody crosses out and get 3 years. I would start with the 5 years. It doesn't, I've bought a lot of companies. I've probably purchased close to 120, 125 portfolios over my time. And so without contracts, I wouldn't pay you for them. Okay, I'm not going to buy them. But your term, as long as it's 3 to 5 years, the renewal terms have to be at least year to year. You don't want a month-to-month renewal in your contract, because basically you don't have a contract. Okay. And we look at how long customers stay on, too. I mean, if you're being acquired, we'll break it up by start year, see how long your customers are staying on and things like that. There's a lot of due diligence that's done on the customer base. So.
Maybe more important than the term in not having a contract is not having any legal protection. There are a lot of standard form protections in a contract that protects an alarm company from being sued for big losses, and certainly enables you to get E&O insurance. So I would think that you might have a struggle with your E&O company as well if you don't have any contracts.
We have contracts, but if you're in
Oh.
this area long enough,
Okay.
you'll hear on the radio, 995, no contract. So it's
Wow.
a hard market.
Maybe what they're saying is,
I don't know anybody that's getting more than 2 to 3 years right now.
yeah.
Well, we buy accounts also, and we generally, it goes back to the attrition rate and great service and that, there may, if you buy 500 accounts, there may be some customers in there that are halfway through their 5-year agreement or just in their first year. And then there may be customers that have been with that business for 15 years and really are on a month-to-month basis. So we really don't price it based on that. First of all, they have to have contracts because of liability reasons and insurance, everything like that. It's a matter of retaining the account through great service. I mean, if you really tick a customer off, if you really get them angry, they're going to tear up the contract and see you later. You can't go waste your time going around chasing them. And I'll give you a quick little story here. We actually had, for a number of years, what we call the contract renewal department program. In other words, they track things and they would send out new contracts for customers to sign, et cetera, et cetera. And that is a lot of work. That is a lot of work. We finally sat down and figured out how much money we're putting into this annually. And what we were doing is, usually a person isn't going to sign a renewal without getting something in return, no matter how you present it to them. And so typically what you'd give them is say a 2-year rate lock. So now you've taken off the table the ability to raise that customer's price, et cetera, for a period of time. So about 2 years ago, we decided to can the whole renewal project and focus on making sure everybody's got a good contract, et cetera. We haven't been hurt by it really since then. And in the $9.95 1 month at a time, I don't think he can sustain that. I mean, he's probably using a third-party station. I mean, so, say $4 a month. It's got to be caught, it might be a la carte or whatever, but say $4. I don't see how you can sustain, generate enough capital in the business with a $5 margin on an account.
I would tell you don't want that customer anyway.
Right.
Because when you have to
Exactly.
service it, he's going to expect you to charge $10 when you go out.
Or
So
nothing.
Just let him have his $9.95
And he'll never give you a
customer,
price
okay?
increase.
There's some customers you don't want. That's one of them. So let him have it.
I have a question about the follow-up on hers, and I'm sure whatever company she's talking about would have a contract, just a month-to-month contract.
Right.
So they're not just doing it
Right.
and not worried about liability, but how would you say that valuations change when, if you are on a month-to-month basis, like let's say after your 3-year, 5-year
Yeah, we'll buy accounts, we'll buy a business that hasn't had a renewal program. I mean, he's continually selling, so he's got some fresh paper in that there, but he might have customers that have been with him 10, 15 years, and he still has the original contract, and he's never renewed it, and they're really month to month. Now, if a customer's been there for 15 years, that's a pretty good sign that they've paid every bill. That's a pretty good sign. The more important thing would be to see if that's a good industry standard contract. And we'll buy those. Now, I say we don't have a renewal project, but if we buy a group of accounts, this does get complicated, but we will do a renewal of contracts for all the accounts we buy, for a couple reasons. To get some fresh paper there, and also to flush out, if there's a bunch of issues or whatever.
It's not that I don't think that they're worth anything. It's just that if you have a contract, let's say they were 3 or 5 year contract and now they're on month to month. The problem is, as an acquisition company, you're usually leveraging, so you're usually borrowing, okay? And when you have month to month renewals, the lenders generally will not lend the money for that account. It doesn't mean we wouldn't buy it as a percentage of whatever is there, but that's the problem. Most acquirers have to go out and borrow money to do so. So there's certain standards that the lenders require on a contract, and for that. I've had, we've purchased contracts where they've had maybe a certain percentage with no contracts, okay? And so we group them all in. And I would say that if everything else was good with that customer, that doesn't have a contract, like they pay on time, there's no service, terrible service records or anything like that, that customer will probably stay on as long as one that has a contract. But again, you're not protected from limited liability or things like that.
There would be a contract, it would be a
The month to month, but the main thing is getting somebody to buy and being able to borrow to buy it.
So my question is, let's say one company has 3-year contracts and another company has month-to-month contracts, or all their customers on month-to-month. And if you're acquiring, maybe you're gonna offer a 30 multiple on the company with the 3-year contracts. How different would the multiple be?
If every contract was month to month?
Yeah.
I don't know the answer to that, because I know I wouldn't buy
You know,
it.
There's a lot of variables to look at.
It shouldn't be 0, but I would assume it would be
Right.
less than 30.
one thing I can assure you is whoever the buyer is going to start low. And they're going to say, the reason is because you've got month-to-month contracts.
Because people can just walk.
So if there's a pool of customers that are month-to-month, but you've had them for 3 or 4 years, you make a counter argument that these customers have proven themselves. If they're all 6 months old, then it's a tougher argument.
The other thing
Good
is if
example.
we buy you and you come on, right, and you're part of the new company, so the transition's easier, right? If they're all month to month, but let's say you're selling, you're retiring, you're gone. We're really at a very high risk, because there's nothing to force that customer to give us a chance to service them, right? We can't hold them for 6 months or a year and say, well, give us a chance to correct whatever you think the problem's going to be.
I think Mark's point about the banks, though, is critical. Even though it seems unrelated and you can make a good argument for value, if the lender is not willing, because of their internal credit standards, to lend against contracts that are month to month, you're stuck, and the buyer's stuck, and that's just that. They could be worth a lot, but the recognition's not going to be there. So it just creates another hurdle. So it's better to get 3-year contracts.
I'm so interested because our contract's still month to month after the 3 years.
Yeah, and
Well, that's different.
That's a
different.
little different.
Yeah.
Yeah, right. Yeah.
It's,
Although you haven't
still
changed
hard
that.
for the lender to,
That's what I'm thinking.
Yeah, I changed it to annual. I know some people that it automatically kicks into another 3-year contract, but, if people are going to leave, you're probably going to let them go. But year to year is typical.
I would recommend successive 1-year renewals.
And that automatic renewal is, there are state laws on what you can do with that too, and et cetera, so you need to be familiar with that.
Yeah, there's certain states that don't allow auto renewal. just so you know. I'm pretty sure, like, one off the top of my head is New York.
Exactly.
Okay? Does not allow for auto renewal.
That's why you have to have a great customer
And
service
the,
program.
and the problem is so, if you have an issue where something happens and you get sued, you're not protected under that contract that you thought auto renewed. So make sure you know, I would personally, I would talk to an attorney, an industry attorney, let him look at your contract. And so he knew, you know, I was in another seminar with, where he talked about video, RMR, and they're talking about there needs to be certain language now in your contract for that. I'm not an attorney, so I can't tell you what that needs to be, but they're saying that's becoming an issue too. So you should definitely, if you're going to sell video products, you should probably talk to an industry attorney. No more questions?
If not, we'll
Wow, perfect. That's all we gotta get a drink.
It's been a long day.
On the guy who asked too many questions.
No, very good. Thank you.
Thanks. Good. Thanks.
Thank you.
Thank you.
Good work. Stay in touch.